Silver forecasts 2026. Analyst targets. From $41 to $200 explained. This is not a story about price going up or down. It is a story about why the numbers no longer agree. Why respected analysts are standing on opposite sides of the same market. Why a $40 forecast and a $200 forecast can exist at the same time. And why that gap is not optimism, it is pressure. Because in silver, disagreement has always arrived just before something breaks. Not quietly, not gently, but suddenly. And once it begins, the market does not wait for permission. Welcome to hidden currency. If you value calm analysis over noise and structure over headlines, you are in the right place. If you're watching this and you have lived through more than one market cycle, you already know why subscribing matters now. This is not about speed, it is about memory. Take a moment, subscribe, and tell us where you're watching from. The United States, Europe, Asia, or somewhere else entirely. Because what follows concerns decision makers everywhere. At the start of 2026, silver was no longer an ignored asset. It was no longer treated as a side note in commodity markets. Yet the most important signal was not the price itself. It was not the previous year's breakout. It was the disagreement surrounding silver's future. Across financial institutions, research desks, and independent analysts, forecasts had spread apart dramatically. Some projected silver near $40. Others openly discussed targets well above 100. This divergence was not a matter of optimism versus pessimism. It reflected something deeper, a fracture in how the market itself was being interpreted. Historically, silver has never entered periods of extreme forecast dispersion without consequence. Wide disagreement has often appeared when the market transitions from one phase to another. Not from weakness to strength, but from momentum to pressure. By January 2026, silver had already completed its most visible move. The breakout of 2025 was no longer a surprise. It had been absorbed. Prices above former resistance levels were becoming familiar. That familiarity mattered more than most realized. When higher prices become normal, behavior changes, risk perception shifts. Investors adjust position sizes. Confidence replaces caution. Markets become less forgiving. This is the point where recognition ends and digestion begins. Before the breakout, silver existed in a state of neglect. Participation was limited, expectations were low. The early rise was driven by revaluation, the realization that silver had been mispriced relative to inflation, supply constraints, and industrial demand. That phase rewarded patience, but once belief spreads, structure changes. In early 2026, silver was no longer trying to convince the market of its relevance. It was testing whether the market could handle its own expectations. This test had little to do with fundamentals. Supply deficits remained. Industrial demand from solar manufacturing, electrification, and advanced electronics continued. Mining supply had not suddenly expanded. What changed was positioning. As large price targets entered public discussion, they influenced more than sentiment. They influenced behavior. More participants entered the market. Leverage increased quietly. Assumptions about continuation embedded themselves into price. This did not resemble reckless speculation. It resembled crowded belief. Silver does not absorb crowded belief smoothly. Its market is smaller than most. Liquidity is thinner. Price reacts quickly to shifts in positioning, moves overshoot in both directions. This characteristic intensifies after large advances rather than disappearing. By early 2026, silver had entered a pressure phase. Pressure did not come from weakening demand. It came from expectations layered on top of a completed breakout. Expectations weigh more than demand because they change how participants respond to volatility. In this phase, price becomes unstable, even when fundamentals remain strong. Pullbacks feel sharp. Rallies feel unreliable. Movements appear contradictory. This is often mistaken for confusion. In reality, it is sorting. The market is determining who belongs in the trade and who does not. Many participants confuse long-term belief with short-term exposure. They hear bullish forecasts and assume time will resolve volatility. Silver does not behave this way. It compresses, then releases. Sideways periods last longer than expected. Corrections arrive faster than expected. After a historic year, silver was no longer debating whether it deserved higher prices. That debate had already ended. The question had shifted to whether positioning had outrun balance. Balance is not restored through commentary. It is restored through time, volatility, and the removal of excess. This is why disagreement mattered more than the forecasts themselves, why dispersion signaled rising uncertainty. It showed that models were struggling to adapt. It indicated that outcomes would depend less on averages and more on sequence. Silver in early 2026 was not weak. It was sensitive. That sensitivity was the warning. Not panic, not collapse, awareness. Because in silver, information arrives before price does. As silver moved deeper into 2026, the conversation around the metal began to change in a subtle but dangerous way. Forecasts were no longer being treated as analytical tools. They were being treated as conclusions. This shift marked a critical turning point in how risk was being understood and misunderstood by the market. Forecasts exist to describe scenarios, not outcomes. Each projection is built on assumptions about growth, policy demand, liquidity, and human behavior. When those assumptions shift, forecasts lose precision. In stable markets, this limitation is manageable. In pressure markets, it becomes a liability. Silver had entered such a pressure market. After the breakout year, institutions were forced to update their models. The old frameworks no longer fit. Silver had not behaved the way it was expected to behave. Prices had moved faster. Participation had expanded more quickly. Volatility had arrived earlier than models suggested. Recalibration was necessary, but recalibration came with disagreement. Some institutions remained cautious. They acknowledged strong fundamentals, but emphasized consolidation. Others adjusted upward aggressively, incorporating supply deficits and long-term industrial demand into higher price assumptions. Independent analysts went further, discussing extreme upside scenarios. This widespread was not a sign of insight. It was a sign of strain. When forecasts cluster tightly, markets are usually stable. When they scatter widely, uncertainty is rising. In silver's case, the spread between conservative and aggressive targets revealed that the market was no longer anchored by consensus. Without consensus, price behavior becomes more sensitive to shocks. The danger was not that forecasts were wrong. The danger was how they were being consumed. Many participants interpreted forecasts as promises. If silver was projected to reach higher levels, they assumed time alone would deliver those outcomes. This belief reduced caution. It encouraged leverage. It compressed patience. Risk management weakened quietly, not dramatically. Silver does not tolerate this condition for long. Unlike assets with deep liquidity, silver has limited capacity to absorb crowded positioning. When too many participants align around a single expectation, the market responds by testing that alignment. It does so through volatility. Sharp pullbacks, sudden reversals, and prolonged sideways movement are not anomalies. They are mechanisms. This is why strong fundamentals do not guarantee smooth price behavior. Industrial demand can remain steady while price becomes hostile. Supply constraints can persist while markets correct sharply. These outcomes appear contradictory only if one assumes fundamentals control short-term movement. In silver, they do not. By early 2026, silver was no longer undervalued. It was fully valued relative to expectations. That distinction mattered. In undervalued markets, good news lifts price easily. In fully valued markets, good news must exceed expectations just to maintain price. Anything less invites disappointment. This was the environment silver entered. Industrial demand continued to grow. Solar manufacturing consumed a growing share of annual supply. Electrification increased silver intensity per unit. Advanced electronics and data infrastructure pulled future demand forward. These were real forces, not speculative narratives. But factories buy silver methodically. Markets do not. Price movement reflected not just consumption, but positioning. Futures activity expanded. ETF flows reversed. Retail participation increased after key technical levels were broken. These participants did not disappear when the calendar changed. Their positions remained. Their expectations remained. The market had to absorb them. Absorption takes time. This is why some institutional forecasts remained conservative despite strong fundamentals. They were not denying demand. They were accounting for digestion. After extreme gains, markets need balance more than they need new buyers. Balance cannot be forced. It emerges through volatility and duration. Silver's smaller market size amplified this process. Liquidity thinned quickly during stress. Price reacted faster than participants expected. Moves overshot. Corrections felt excessive. These reactions were not signs of failure. They were signs of recalibration. Another structural constraint remained unchanged: mining supply. Most silver is produced as a byproduct of other metals. This limits responsiveness. Higher prices do not immediately bring new supply online. That supports long-term value, but does nothing to stabilize short-term behavior. This is why silver behaves like a system under load. When pressure builds gradually, it trends. When pressure builds too quickly, it releases violently. In 2026, pressure was coming from expectations layered on top of fundamentals. Forecasts contributed to that pressure. They raised the stakes. They encouraged participation at increasingly fragile points. They shifted focus from process to destination. And silver punishes that shift more than most assets. The market was no longer asking how high silver could go. It was asking how much excess needed to be cleared first. That excess did not sit in vaults. It sat in positioning. And until it was resolved, silver's path would remain uneven, regardless of how strong the story sounded. By the time silver moved further into 2026, the market faced a situation that appeared stable on the surface but was increasingly fragile underneath. Prices were holding above levels that once seemed impossible. Headlines continued to reference supply shortages and industrial demand. On paper, the story looked strong. Yet beneath that strength, a quieter risk was forming, one that rarely announces itself in advance. This risk did not come from collapsing demand or rising production. It came from timing. Markets do not fail because fundamentals disappear. They fail when expectations move faster than structure can support. Silver, more than most assets, is sensitive to this imbalance. Its market size is small, its liquidity is thin, its participants are diverse, ranging from long-term industrial buyers to highly leveraged financial traders. When these groups interact under pressure, instability increases. In early 2026, silver's fundamentals were no longer in question. Industrial demand remained firm. Solar manufacturing continued to absorb a large share of annual supply. Electrification projects increased silver usage per unit. Advanced electronics and data infrastructure pulled future demand forward. These trends were measurable and persistent, but fundamentals explain direction, not behavior. Price behavior is shaped by who is holding positions, how they are financed, and how they respond to stress. After the surge of the previous year, silver was no longer held primarily by patient capital. It was increasingly held by participants expecting continuation. This distinction mattered. When markets are driven by expectation rather than value discovery, they become less tolerant of delay. Sideways movement feels like failure. Pullbacks feel like threats. Volatility becomes personal. This is when decision-making deteriorates. Silver does not smooth volatility over time. It concentrates it. This characteristic becomes more pronounced after large moves. Instead of gradual corrections, silver tends to compress price action and then release it suddenly. This is not random. It is a function of limited liquidity interacting with leveraged positioning. When pressure builds without relief, the release is sharp. By 2026, signs of this dynamic were already visible. Rallies became shorter. Pullbacks became faster. Price movements appeared disconnected from news. Many participants interpreted this as manipulation or confusion. In reality, it was adjustment. The market was recalibrating exposure. Another factor added complexity: inventories. While supply deficits persisted, available inventory was not evenly distributed. Much of the silver required for industrial use was not freely circulating. This reduced the market's ability to absorb shocks. When liquidity thins, even small changes in positioning can produce outsized price moves. This environment punished assumptions. Many investors believed strong fundamentals placed a floor under price. In silver, floors are rarely stable in the short term. Downside risk is not eliminated by demand. It is delayed. When corrections arrive, they often exceed expectations, precisely because confidence had grown too comfortable. Silver's history supports this pattern. In past bull cycles, the most painful drawdowns did not occur at the beginning of the move. They occurred after belief became widespread, after narratives solidified, after forecasts became consensus. That stage had arrived. At this point, the market was no longer deciding whether silver was valuable. It was deciding how much imbalance it could tolerate. Excess did not exist in production or consumption. It existed in exposure. Too many participants shared the same assumptions. Too many positions relied on time rather than margin for safety. This is where pressure markets test discipline. Long-term holders and short-term traders experience this phase very differently. Well-capitalized participants can absorb volatility. They adjust position size. They manage risk. Others cannot. Forced selling does not occur because fundamentals change. It occurs because positioning becomes unsustainable. This process often feels unfair to those caught in it. Strong stories remain intact while prices fall sharply. Confidence is challenged not by new information, but by structure. This is the nature of silver's market. By early 2026, silver had transitioned from expansion to evaluation. It was no longer expanding belief. It was evaluating it. The market was asking which expectations were realistic and which were excess. This evaluation does not happen through debate. It happens through price action. Those who misunderstood this phase looked for reassurance in forecasts. Those who understood it looked for balance. They recognized that volatility was not a threat to silver's long-term role, but a test of how exposure was managed in the present. Silver was not signaling collapse. It was signaling selectivity. And in markets like silver, selectivity determines who remains positioned when the next phase begins and who is forced to step aside before it does. As silver progressed through 2026, the market entered its most decisive phase. This phase was not defined by price targets, forecasts, or headlines. It was defined by behavior. Pressure markets do not reveal their outcome early. They reveal who is positioned to survive long enough to benefit from that outcome. By this stage, silver had already done something rare. It had forced a global reassessment of its role in the financial system. It was no longer viewed only as a secondary metal or a speculative trade. It had re-entered strategic discussions around industrial supply chains, currency stability, and long-term asset allocation. That shift was real, and it was unlikely to reverse. But recognition does not guarantee reward. The final phase of a pressure market is not about being right. It is about being positioned correctly. This is where many participants fail, not because their thesis is wrong, but because their exposure is mismatched to the market's behavior. Silver's behavior in this phase was clear. It punished excess confidence, it punished leverage, it punished impatience. At the same time, it rewarded discipline, liquidity awareness, and time alignment. These rewards were not obvious. They did not come through smooth gains. They came through survival. The most important mistake participants made was assuming that strong fundamentals would protect them from volatility. In silver, volatility is not a temporary inconvenience. It is a structural feature. Those who underestimated it learned quickly that conviction without flexibility becomes vulnerability. Pressure markets resolve excess before they deliver clarity. This resolution does not follow a schedule. It unfolds through repeated tests, sharp declines followed by incomplete recoveries, rallies that fail earlier than expected, extended periods of sideways movement that exhaust attention and confidence. These are not signs of weakness. They are signs of filtration. The market filters participants based on resilience, not belief. Institutions understood this dynamic better than most. Many reduced exposure after the breakout, not because they were bearish, but because they were managing risk. They waited for balance to return. Retail participants, in contrast, often increased exposure after confirmation, assuming the hardest part was over. This difference in timing created asymmetry. Silver does not reward late certainty. Another defining feature of this phase was information overload. Forecasts multiplied, opinions intensified. Each new projection appeared to validate or invalidate existing positions. This noise distracted from what mattered most: structure. Structure determines how price reacts under stress, and structure by early 2026 was still unstable. Liquidity remained thin, positioning remained uneven, expectations remained elevated. These conditions meant that even positive developments could trigger volatility. Good news no longer pushed price higher automatically. It often revealed how crowded positioning had become. This confused many participants. They expected alignment between news and price. When that alignment broke, confidence weakened. But markets do not exist to validate expectations. They exist to clear imbalance. Silver was doing exactly that. The final lesson of this phase was simple but difficult to accept. Long-term opportunity does not remove short-term danger. In fact, strong long-term opportunity often increases short-term danger by attracting excess participation too quickly. Silver's role as a strategic asset was strengthening. Its role as a stable trade was not. Those who understood this adjusted their approach. They reduced position size. They avoided leverage. They allowed time to work without forcing outcomes. They recognized that being early and being right are not the same as being positioned to benefit. Those who ignored this lesson learned it through volatility. Pressure markets do not announce their turning point. They emerge from exhaustion. When excess is cleared, when expectations reset, when participation narrows to those aligned with structure, not headlines, only then does the next phase begin. Silver had not reached that point yet. What it had done was expose a critical truth. Markets do not reward belief alone. They reward alignment between thesis, timing, and risk. In silver, misalignment is punished quickly and without warning. The outcome of silver's next move would not be decided by forecasts or famous names. It would be decided by who remained positioned after the pressure phase completed its work. And by the time that clarity arrived, most observers would already be gone, convinced they were right, but positioned too aggressively to stay. That is how pressure markets decide winners long before the outcome becomes obvious.